York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. It's go time. President Trump's sweeping new tariffs kick in. Switzerland and India get hit with some of the highest rates. A threat and an exemption. The president announces 100% chip tariffs, but zero for the likes of Apple, who invest in the U.S. And the Fed's outlook. Trump says that he'll name a temporary governor, while 3 other Fed officials signal that it's time to adjust rates. And we are higher this morning, despite the fact that at 12:01 a.m. we had tariffs kick in, despite the fact that chip makers are going to get 100% tariff. But there was a key exemption. If you invest in the U.S., you'll get 0%. And that's maybe why we're seeing the rally underway this morning. We're up by more than 0.5%. By the way, the Mag 7 hitting another all-time high yesterday. For this bond market, a little bit of a different driver. It was the Fed speak. Kush, Kashkari, and Daly all out yesterday talking about it is time to adjust rates. So we had a front-end rally. Little change this morning, but still we are slightly lower with your front-end yields at 3.70 for the 2-year yield. The long end was under pressure yesterday. We had a pretty dismal bond auction for 10-year yields. That's at 4.23. We'll get a 30-year auction today. Let's get you some stocks moving in the pre-market, including those chip makers. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Yes, let's start with TSMC, the largest chip manufacturer based in Taiwan, really cheering these tariff exemptions. Those shares are up 5.2%. I know you mentioned that Mag 7 was trading at record highs. We also have TSMC trading at record highs in the back of this optimism that now we don't have to worry about these sectoral chip tariffs. Let's move on to the broader tech industry because we are decently in the green. I want to start off with NVIDIA, one of the biggest out there, up nearly 1%. Apple up nearly 3%, Danny, and this comes after it had its best session since May, up 5% yesterday, adding to that again in pre-market as it gets those tariff exemptions. Global Foundries, this is also related to Apple. Those shares up 9% in the pre-market. This is something that they're increasing their ties to Apple. That was announced yesterday. Now, Global Foundries is a chip manufacturer, has 3 manufacturing sites in the U.S. As you can see, the reason why Apple wants to build more of its products in the U.S. and Global Foundries is going to help it do that. Let's move on to one more stock that is moving lower after earnings, and that is Airbnb. This is the hotel web booking website, down 5.7%, Danny. This comes after, even though their results did come in with a beat for the previous quarter, they gave quite a modest guidance on the year ahead, saying that they're going to face some tough comparisons year on year through the remainder of the year. Danny.
Valerie, thank you very much for this roundup. We'll catch up with you later in the hour. Also in this hour, we'll speak with Nandini Ramakrishnan of JPMorgan, who joins us to look at the impact of Trump tariffs on emerging markets. And we'll discuss how questions of the economic data integrity and a new Fed governor will affect the outlook with Thierry Wizman of Macquarie. But first, our top story. After months of threats, reversals, talks that led to deals and talks that haven't, President Trump's sweeping new tariffs are officially in effect. Joining us to break down the key details is Bloomberg senior editor Bill Ferries. So, Bill, the tariffs are being implemented just on an overall basis. How much confusion, how much certainty is there as they start to work their way through the system?
Well, there was a rush to get goods on their way before that midnight deadline last night in the U.S. Average U.S. tariffs are now up at over 15% compared to just about 2% when President Trump took office. So that is going to have a huge impact sooner or later on the U.S. economy, global trade flows, and the global economy. We haven't seen a huge influx or increase in inflation so far in the U.S., but we have seen from some of the latest economic data that the economy appears to be nearing more of a stall speed when it comes to things like job creation. So the impact is probably starting to filter through, and the expectation is in the months ahead, we're going to see that tariff hit start to take effect.
In terms of the haves and have-nots, Bill, in the latter category, there's the likes of India and Switzerland that are facing really punitive rates. What went wrong?
Yeah, well, first on India, I mean, that has been a 180-degree turnaround from what I think most of us expected maybe 3-4 months ago. The administration was talking about India being near the front of the line. President Trump and Prime Minister Modi have had a close personal relationship going back to Trump's first term. It seems like the more President Trump focused on Russia's continuing war in Ukraine, the more he looked at things like the BRICS bloc and some of their moves to separate or limit trade with the U.S., the more frustrated he got with India. The relationship has really kind of broken down. India has avoided escalating the situation, but right now they're looking at potentially 50% tariffs in 3 weeks' time when this extra 25% kicks in. And then you have Switzerland, which failed. Their president failed to get a meeting with President Trump when she visited the U.S. this week. The 39% tariff is the highest among industrialized nations. All of Switzerland's neighbors, or many of them, are paying as little as 15%. So that's going to create a huge competitive gap that Switzerland's going to struggle to deal with.
And when it comes to the question of Russian oil, Bill, it's interesting because it really feels only like India that's faced this scrutiny. China certainly buys Russian oil, too. How are discussions evolving there when it comes to China and their tariff rates?
Yeah, I mean, China actually buys more Russian oil, about 2 million barrels a day, than India does at 1.7 million. President Trump has really not focused on the Russian oil component of Chinese trade so far. He wants a deal. I think the big difference between these two countries is with its rare earth magnets and its influence over that market, China has a lot more leverage over the U.S. than India does. There's no comparable key product for India that it sells to the U.S. So that's been the difference. The president has said that maybe he'll consider the Russian trade when he deals with China, but I think he's got his eye on a bigger picture trade deal, and he's talked about meeting Xi Jinping to sign that deal later this year.
Bill, thank you so much for this. So much to go through. Helpful to have you on. That's Bill Ferries. Let's stay on trade, though, because Apple and chip stocks, as Valerie was laying out, are in focus and rallying this morning. Apple adding another 3% onto its rally from yesterday. The president announced further plans for his sectoral tariff regime yesterday. Speaking in the Oval Office alongside Apple CEO Tim Cook, Trump declared that he would slap on eye-watering tariffs on semiconductors.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
Roz Matheson joins us now. Roz, how would these exemptions work?
Well, it's very unclear how they might work and whether, in fact, Donald Trump just kind of floated this in the minute when he was having that meeting with the Apple CEO. Does he mean on chips coming in to the US? A couple of big chip makers really around the world who have a lock on the global market and are already rushing to show that they're investing in the US. So would they get an exemption? Is it separately to that anything that is an electronic device that's brought into the US that contains a chip? It's very, very unclear exactly what Donald Trump was meaning, but the fact he even talked about carve-outs, exemptions for these companies that are investing in the US suggests that a large slice of the market might in fact get an exemption. That's why you're seeing a pretty low-key reaction in the market today. But if you look underneath that, are there mid-tier, smaller-tier chip companies, including particularly in Europe, who might actually find themselves vulnerable in all of this? We're trying to understand all of that today because underneath those exemptions, there are companies that are potentially quite impacted.
And there are companies that maybe have found their way to the exemption. To your point, Roz, Apple seems to be one of them. You can see shares up 3% in the pre-market. They rallied 5% yesterday after talking about investing in the U.S. But Roz, what sort of moves are Apple and other companies having to make to try to skirt some of the supply chain pressures and make sure they're on the White House's side?
Well, it's interesting to see the playbook that company executives seem to be using in the US. We saw that even at Donald Trump's inauguration, where they're all lined up in a way paying homage to him in the minute and getting this idea that Donald Trump is essentially a businessman. He's a showman. So they're turning up at the White House, having their meetings. They're promising investment. The interesting thing is in all these vast amounts of money that are being promised by companies to put operations, manufacturing, factories and whatnot in the US, how much of it has to actually eventuate in the end? Are they promising stuff that they've already pledged previously and they're rebundling? Are they promising factories and other buildings that could take many, many years to build and may never actually have to build? The question is, of all this money that's being pledged, how much is going to be a reality, but how much actually matters in that for Donald Trump? Really, for company CEOs, it's about realizing the playbook that you need to operate with under this administration. And the main thing, of course, is to show that you're hearing Donald Trump on his messages and you're really promising you're going to bring jobs, manufacturing and business back to the US.
Roz, while we have you, because it's not just been companies that have been promising investments, it's the likes of countries too. And where you sit in Europe, many countries have also promised the same thing. In fact, that was part of the deal with the tariffs with the EU. Do we know how that's playing out with tariffs officially kicking in?
Well, the interesting thing in all this, again, is the question of what it means more broadly for trade globally, what it means for businesses. Can investment come in to the US? But obviously, you know, for global companies looking at this, as Bill was saying a minute ago, the impact on the US economy is still very unclear, and therefore on the global economy is unclear. So do we see a rise in inflation at some point? Do we see supply chains being completely reorganized around the world as a result of this? But certainly you can see, if you're a CEO, if you're a head of state, you're all still trying to work out exactly how it is that you do business with Donald Trump under this administration.
All right, Roz, thank you very much for that. That is Bloomberg's Roz Matheson. Let's now get you some other top stories that are trending on the terminal this morning. The Kremlin has confirmed that President Donald Trump will be meeting Russia's Vladimir Putin within the next few days. Putin met with Trump's envoy, Steve Witkoff, yesterday in the Kremlin for nearly 3 hours of talks. The U.S. is pushing for an end to Russia's war in Ukraine. 3 Federal Reserve policymakers, Mary Daly, Lisa Cook, and Neil Kashkari, have voiced concerns yesterday about the U.S. labor market. They pointed to a potential interest rate cut in September. Kashkari expects the Fed to lower rates twice before the end of 2025. Daly said 2 cuts are likely appropriate this year, but the Fed may need to cut more than twice. And the Bank of England is set to cut their own interest rates today. It would mark the lowest level in 2 years. Policymakers are contending with a slowing economy and a jobs market rattled by higher taxes. Economists predict a 3-way split on the committee, with the majority supporting a quarter-point reduction. Coming up, high tariffs for India and other emerging markets loom. JPMorgan's Nandini Ramakrishnan will be joining us next for the read-through to markets. Stay with us on your brief.
India will never compromise on the interest of farmers, fishermen, and dairy farmers. I know personally I will have to pay a heavy price for it, but I am ready for it.
India's Prime Minister Narendra Modi speaking in New Delhi after tariffs of 50% kicked in for India, one of the most punitive of Trump's tariff rates. Nandini Ramakrishnan of JPMorgan writes, quote, while most economies are feeling some effect, many equity markets are much less affected. India, Brazil, Indonesia equity markets all source 80 to 90% of their revenues domestically. I'm pleased to say that Nandini joins us now. She's emerging market equities macro strategist at JPMorgan. Nandini, great to see you this morning, and we'll get into the impact in just a moment, but I would love to get your thoughts on just why India seems to be such a concentration of this president and what you make of the 50% tariff rate that they've been slapped with.
So globally, I think we thought that India and the U.S. may have had a more amenable or seamless negotiation in the tariff process post-Liberation Day. But it is interesting that the U.S. administration has singled India out on the energy imports issue. And I think that brings to light that maybe all countries are not going to be treated the same, right? China is still under negotiations. There's various other issues that the U.S. and China would need to work out there. And the India negotiations shows us right now that there's maybe a singular approach that the U.S. administration is taking for each of these countries, especially because India has been in the spotlight for maybe being the beneficiary of a China tariff issue as China +1 or new manufacturing hub of the world. It does look like the U.S. administration is focusing on some of these issues to try and gain that competition back as production may leave China to other parts of the world.
Well, so as some of these emerging markets get 50%, Nandini, does it change your outlook? I know you mentioned, as we read, that most of the revenue is sourced domestically for the equities in these markets. But is there a point where the tariffs are punitive enough that you'd likely see some local impact because of the economic ramifications?
Certainly. One thing I can tell you working in emerging markets for many years is there are a wide array of countries with a lot of different dispositions, you can call them. So for countries like Korea and Taiwan, which are extremely export dependent, produce a lot of global technology, tariffs are going to be quite difficult for them. The equity market sources much of its revenues from the export part of that economy. While I mentioned, as you said, Brazil, India, Indonesia, those equity markets, not the economy, the equity market sources most of its revenues from the domestic country. So for India in particular, the U.S. is the largest trading partner. It's a huge part of some of those software and services industries that India has. But actually, 80 to 90% of India's equity market comes from local domestic consumption, spending, financialization, all these long-term structural themes that we constantly love about India when they're at a good price, of course. India's valuations are a bit expensive in the equity market, so there's a bit of pickiness we have to apply there for companies. But overall, these tariffs actually have less of an effect on the Indian equity market than it does on the economy as a whole.
Well, it's also interesting because we were listening to Prime Minister Modi there, and among the things he said is, I'll have to pay a heavy price. He probably was talking maybe politically about paying a heavy price of standing up to Trump. But there's also this idea that perhaps what India and others will have to pay is fiscal expansion if they're to support their economies that are under stress. Do you assume that we're about to enter an era of fiscal expansion for a lot of these emerging markets who are coping with the fallout?
Well, it's actually interesting. Two of the countries in our coverage that have had slightly higher than expected tariffs in the past few weeks, Brazil and India, especially the headline numbers, are actually two countries that the macro is really accommodative to easing fiscal stimulus and basically a domestic economic positive scenario, right? So you've got high real rates in Brazil, a central bank who has been really disciplined before and now can possibly cut. In India, you have some of the lowest inflation numbers we've seen in many years, even decades. So with low inflation, the RBI, central bank in India, can actually think about easing a bit more than they may have been before. So there's actually while tariffs, I can tell you as an economist, are never going to be a great thing overall for global trade, there's actually some counterintuitive benefits to the economies that have been hit worst with these recent tariffs that they actually can stimulate domestically. And again, as an equity investor, that's actually maybe good news in terms of those domestic revenues coming into the equity market in that sense.
Nandini, really wonderful to get your views this morning. Thank you for joining us. Nandini Ramakrishnan of JPMorgan there. Coming up, Citi CEO Jane Fraser is the latest banking executive to meet with President Trump. We'll have more on the C-suite coming in and out of the Oval Office. That's coming up next on your brief. You're watching Bloomberg Brief. I'm Dani Berger in New York. Let's take a look at what is on the front pages of major publications this morning. First up on the front page of basically everywhere this morning is President Trump's tariffs taking effect. New tariffs on more than 90 countries kicked in after midnight. Hours before they took effect, Trump signaled that there would be more to come. He doubled down on his strategy. Next up on the Wall Street Journal, President Trump said that there was a good chance that he would soon meet with Russian President Vladimir Putin. About an hour ago, Russia's Interfax also reported that the Kremlin confirmed a meeting in the next few days, that it has been agreed upon after being proposed by Special Envoy Steve Witkoff, who spent 3 hours at the Kremlin yesterday. And on the front page of the Washington Post, they are reporting that Director of National Intelligence Tulsi Gabbard overrode arguments from the CIA to release a classified report on Russian interference in the 2016 election. Officials worried that the release could reveal top secret spying techniques and sources, but Gabbard authorized a lightly redacted version. Now, another story we're keeping an eye on this morning. Citi CEO Jane Fraser is the latest major bank executive who has been meeting with President Trump. Also spotted leaving the White House, Bank of America's Brian Moynihan. Conversations abound about what's happening with Fannie and Freddie and others. Joining us for this conversation is Bloomberg's Tom Metcalf. Tom, what is our understanding at this moment about the conversations Jane Fraser had and others with the White House?
Well, all these big-name CEOs are going to the White House and effectively pitching to be part of any possible IPO of, these two massive mortgage companies. So I imagine, they're laying out everything they could possibly bring to that. And I suspect in those conversations, emphasizing, this is just how much money we could raise off these things.
That's what they want, but who are they likely to choose, Tom? What is sort of the criteria that President Trump is using, as in recent days in that interview with CNBC, he had a lot of ire directed at the banks, claiming that they wouldn't accept his money, the likes of JPMorgan and Bank of America?
Well, I think that probably won't help their cause, right? I can imagine some of the other bigger banks that are, first in line, one would suspect. So yeah, it won't be the usual, I guess, sort of milk round process where, the normal things you tout might be what's most important here. So it'll be interesting to see what the results is. But clearly, the White House going through all the obvious big US banks and, suspect, whoever gets that, top left lead will be very, very happy because there'll be seriously large fees on these kind of transactions.
Yeah, for certain. Tom, thank you very much for that. That is Bloomberg's Tom Metcalf. All right, a quick look at your markets this morning before we head to the commercial break. S&P 500 futures up by 0.6%, a second day worth of a rally led by tech stocks. Mag 7 hits an all-time high, with chip makers getting an exemption from 100% tariffs if they simply invest in the U.S. Coming up, Fed officials sounding the alarm on the labor market, and we break down the Trump's choice for the next Fed governor. We speak with Terry Wizman. That's coming up next. It's 5:30 a.m. in New York City. Good morning. I'm Dani Burger with your Bloomberg Brief. Here's what you need to know on this Thursday. It's go time. President Trump's sweeping new tariffs kick in. Switzerland and India get hit with some of the highest rates. A threat and an exemption. The president announces 100% chip tariffs, but zero for those like Apple who invest in the U.S. And the Fed's outlook. Trump says that he'll name a temporary governor, while 3 other Fed officials signal that it's time to adjust rates. We are moving higher this morning despite the fact that at 12:01 a.m. tariffs kicked in, but it is an exemption for tech chip companies that invest in the U.S. that has something of a relief rally underway. But Russell 2000 futures, those are outperforming, but we're higher by at least 0.6% across the board. The Mag 7 hitting another all-time high yesterday. We did get Fed rhetoric from Cook, Kashkari Daily yesterday that an adjustment is needed. A rally on the front end in your bond market takes place after that. At the moment, your 2-year yield is at 3.7052. The long end under more pressure after an auction yesterday with some pretty lousy demand. 422.87 is where we stand. Let's get some stocks, though, moving in the pre-market. With that is Valerie Taitel. Hey, Val.
Good morning, and Dani, let's start with the enthusiasm in the chip space. We have TSMC, the world's largest chip manufacturer, rising over 5.5% on the back of this excitement around these carve-outs. Remember, TSMC has pledged investment to the U.S. They've even begun production of a manufacturing plant in Phoenix, Arizona. So those carve-outs is what is boosting this stock, and is trading at record highs. The broader chip sector, the broader tech sector is also in the green. Take a look at shares of NVIDIA up nearly 1%. Apple is gaining ground, up over 3%. And this comes after yesterday, Dani, Apple had its best session since May, up over 5%, adding to those gains on sealing that exemption from those tariffs. Global Foundries, this is a chip manufacturer, is also getting a boost, up some 10%. That comes as Apple has increased its ties with this manufacturer, who has 3 production facilities across the U.S. as Apple and other tech names try to increase manufacturing, try to onshore restart that manufacturing back into the U.S. Lastly, it's still earnings season. Let's end with Airbnb. This is the hotel room booking website. Those shares are falling over 6.5% in pre-market trade. The results came in okay. The previous quarter did come in quite solid, but the CEO and the company warning of some soft quarters ahead as it faces some tough year-over-year comparison. And it was that guidance that is leading that stock lower in the pre-market. Danny.
Valerie, I appreciate you explaining what Airbnb is, but I think most people know what it is unless you've been living under a rock. Thank you very much for that roundup. Excellent work this morning. That is Valerie Teitel. Now back to one of our top stories. President Trump has been floating the idea of naming a temporary Fed governor for the vacant seat. Terry Wizman of Macquarie Group weighing in on the implications after last week's jobs report that has more Fed officials turning dovish. He writes, the report may also have the structural effect of justifying the call for having a chair that is more pliable and aligned with the administration's views. That's why yields beyond the Fed's 2-year visible policy horizon fell a lot on Friday. I'm pleased to say that Terry joins us now. Wonderful to see you this morning, Terry. What do you mean about a possible structural change?
It could mean several things. I think that the nuclear bomb, if you will, conceivably could be not just a Fed chair that the administration appoints that is more pliable and more accommodative to the administration's views and urges, let's say through their charisma, through their influential ability, an FOMC that is willing to keep interest rates lower than they otherwise would. Conceivably, though, this could also be a long-term structural change. We get a lot of questions from clients recently about whether a new Fed chair might be able to actually change the Fed's inflation target. In other words, what level of inflation is considered to be, by the Fed, consistent with price stability. And if you recall, it hasn't always been the case that 2% has been the official Fed inflation target. Prior to January of 2012, the Fed did not really have an official inflation target. And there were some members, some Fed officials, some members of the FOMC who thought that 1% or 1.5% was consistent with price stability. So the idea that 2% is the Fed's target is not written in stone, and it's very possible that what the U.S. administration wants ultimately is to not just have a more dovish Fed, but to have a way to do that by raising the ultimate inflation target, maybe to 3%. There are some countries out there that have 3% inflation targets. So this is not outside the bounds of what is conceivable.
It's not outside the bounds of what's conceivable. What would be the impact of it? Because you probably could make a reasonable argument, to your point, other countries use it, that 3% is okay. Would it be okay?
Yeah, look, I think the way that the FOMC, which would need to make this change, and the administration would rationalize this, is that there are a lot of structural inflation trends out there. And these are, it's going to be difficult to avoid the inflation, impede the inflation, if you're setting inflation to be 2%. Some of these trends are just plain old deglobalization, which has the effect of making the global economy less efficient, raises inflation. We have climate change. We have the investments that we need to make for climate adaptability and mitigation. We have adverse demographic changes as well. The baby boomers are retiring, so you can make a case that productivity falls. And as a result, and we have high debt as well, high sovereign debts, not just in the U.S., but around the world. And because of this, governments may want to monetize that debt. And the only way they can do that smoothly is to raise the inflation target and allow the central bank to have more flexibility towards that goal. So there are reasons, rationalizations, why we may want to slip into a higher inflation target. I think those are the underlying drivers and causes. But of course, ultimately, it will be for the Fed and the new chair to decide if the Fed ultimately takes that path.
Well, to your point, you said the FOMC needs to decide. There's been a lot of arguments that it kind of doesn't matter who the Fed chair is, that this is a committee and that they will push back on anything outsized. You said the necessary charisma might sway them. So how important is it to you to see who becomes the Fed chair and just how much they can sway the committee in matters like this?
Yeah, it's very important. I think people forget sometimes that the FOMC is not robotic, that it's not a machine. And that's why I actually don't like the style of analysis that always goes back into history to see what the Fed had done at a particular point in time to find out what it's going to do today. These are different people than there were 10 years or 12 years ago or 30 years ago on the committee. So we have to look at the personalities individually. And these are people, and they respond to sometimes their own conscience, sometimes their own intellectual dispositions. So it's very important, I think, to answer your question, that the next Fed chair, not just be someone who is respected intellectually, but can also argue a case. And usually arguing a case is a matter of charisma. We know that, of course, in criminal and civil trials, that if the prosecuting lawyer is more articulate, might be better looking, they tend to win the case. So I think that this is a situation that might prevail on the FOMC, and because of that, I think the administration has to be very careful on who they nominate ultimately.
So, okay, if we do get this world where inflation is targeted higher, Terry, what I'm understanding from you is that means that the front end is looking pretty attractive. But what does that mean for duration?
Well, it's interesting because, remember, whatever the administration may be able to set in motion, it may only be able to set in motion during the tenure of this administration. If you get a new administration with a whole new economic policy disposition, whatever the administration currently does not have to last. We may have a situation where the Fed under this administration does one thing, but the Fed under the next administration does the other thing. I think ultimately, however, even if you set aside what the Fed might do to try to influence the inflation target or inflation itself, we are heading into a world where there are going to be greater inflationary pressures. Now, what I tell clients is, look, in the near term, we have a cyclical downdraft in the U.S. We may have no more than 1% real GDP growth over the next 2 quarters. And we know that in periods of economic sluggishness, the 10-year yield tends to go down. It has gone down in almost every recession, for example, that we've had in the post-war period. But if you believe that structural inflation is eventually going to be higher once we get past this soft spot, you don't really want to be holding nominal assets. You don't want to be holding assets whose principal value or whose cash flows do not adjust with inflation. So this does not make a strong case for the bond in the long term.
Is there a real risk with that, though? Because you have that case being made. If you have an appointment that looks blatantly political, even let's say there is a real case to be made to have more cuts into this economy, that you get more days like yesterday where a 10-year auction is pretty sluggish, where a risk premium grows and it's harder to fund the twin deficits of America.
Right. So the trade there, if you will, if there is one, is to bet on the yield curve steepening. You want to put on a trade that's effectively duration neutral, but it's still a yield curve steepening. You'll have to pay up a little bit for that trade every month because there is negative carry on that position, but you want to bet on the yield curve steepening. And the yield curve right now is not that steep. I mean, in the swap market, the difference between 5-year swaps and 30-year swaps might be about 40 basis points. In the Treasury market, it might be about 50 basis points. We have had yield curves that are much steeper in the past without all the consternation out there around long-term inflation and who the Fed's next chairman will be. So in the context of everything that's going on, this is not a very steep yield curve yet. It could get steeper, and that is probably one good way, if you can hold on and pay the negative carry over time, to bet on the trends in long-term structural trends in this economy.
Yeah, it's important context for everyone to remember.
Absolutely.
I think, as we all seem to be losing our minds in recent days. Terry, I would love to just get your thoughts, because we had Kashkari, Cook, and Daly yesterday talking about it's time to adjust rates. These markets are pricing in something like 95% odds that they cut in September. Is September set in stone now?
Yeah, I think so. And I've always been sympathetic to the September view because I had a feeling that by the time they were able to see the summer data, they would make the conclusion that the economy is in fact slowing. And my view is that the consumer, especially the low-income household, the low-income consumer in the U.S. has been weak since the middle of last year. It's just that wasn't reflected in the data through the end of last year because we had all of this euphoria around the election. And the high-income households went out to spend, and you saw it with luxury sales, certainly in the fourth quarter of last year, and that masked the underlying weakness in the consumer. But now this year, in the first 6 months of this year, we have in fact seen a much weaker consumer, and that has now been reflected in the labor market indicators. We see with the revisions that the labor market is weak as well, and I think that's enough of a compulsion from the data to cut rates and start with this, renew this easing cycle. Cut rates in September. I don't think that I think the market is a bit way ahead of itself to think that the Fed might be cutting 5 times by the end of next year. That seems a little bit exaggerated. I think for that to happen, you really do need to see a Fed chair that is ultra dovish eventually come into place. Maybe that's what the market is pricing in when it calls for 5 cuts in the swap market. But that would indicate a structural change or a recession. I don't see a recession coming.
Well, this conversation long from over, but unfortunately we're out of time. Terry, so wonderful as always to get your thoughts. Terry Wizman of Macquarie, thank you so much. Coming up on the show, chip imports are set to be slapped with 100% tariff, with a very, very key exception that has chip stocks rallying this morning. We're going to get you a trade update coming up next. This is Bloomberg.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
President Trump speaking yesterday after meeting with Apple CEO Tim Cook at the White House. Apple announced that it will invest an additional $100 billion in U.S. manufacturing. You can see that's boosting Apple shares 3.25% pre-market after a rally of more than 5% yesterday. But the president did announce an 100% levy on imported chips. Bloomberg Washington correspondent Tyler Kendall joins us now. Tyler, as we look through the details of many different tariffs that are being placed on with chips specifically, do we understand how this investment and exemption might work?
Yeah. Hey, Danny. Good morning. Well, there's a few really important distinctions that we have to make here. Yes, President Trump says that we are expecting to get a 100% tariff on chips and that these companies that move manufacturing to the U.S. will be exempt. But keep in mind, when that Section 232 investigation into the chip supply chain was launched back in April, it extended to the entire supply chain, such as consumer electronics. So Apple has actually been under a reprieve for the past few months. But that exemption is really only temporary. And our understanding is that this reprieve will not extend to those downstream products, whether it be iPhones, whether it be cars that use semiconductors. So that's something that is really key here to watch, whether or not you see any other sort of product carve-outs, because for now it appears that this only applies to the actual chips. And to be sure, some of these investment pledges fall short of the White House's initial and original goal to completely reshore production and manufacturing. But as we heard Tim Cook in the Oval Office standing next to President Trump yesterday, he said it's going to take time to move those supply chains, though did point out, for example, that many of the components that go into iPhones are made in the U.S. What is clear is that this administration wants to see the investment pledges, and they want to see them coming in. And this pledge from Apple for $100 billion now brings the cumulative total for other tech companies, including NVIDIA, for example, TSMC, to over $1 trillion, according to the administration's investment pledges. So we're going to have to see how they actually end up shaking out, when they will actually see that investment come to fruition. But one thing's for sure, it's made President Trump relatively happy that he's been able to extend this exemption, at least for chips.
So we have the sectoral tariffs still being worked out, Tyler, but as of 12:01 a.m., right after midnight, we had tariffs for countries kick in. To what degree is there still discrepancies in interpretations versus certainty in how countries are now dealing with these tariffs?
Well, there's definitely still a lot of details that need to be worked out, Danny, because really what we've seen so far have been the frameworks. So importantly, that higher tariff rate has kicked in, and across the board, it's substantially higher. Our analysts at Bloomberg Economics say that the average U.S. tariff rate has now reached 15.2%, much higher than the 2.3% when President Trump took office. But keep in mind, a lot of the key details here, including how some of these countries, some of these trading partners that were able to secure a more perhaps preferential rate of 15%, Japan, South Korea, the European Union, also saw that rate extended to the sector-specific autos. But we've yet to see the text when it comes to lowering that rate, which is going to be really important for those trading partners. And we're still waiting to see the finalized details on some of what the administration would call these unique agreements, including the investment pledges, including the pledges to buy more U.S. LNG and agricultural products. There's still a lot of big questions that we're going to need to see further information about in the coming days. But one thing is for certain, those higher tariff rates have kicked in and the negotiations continue.
That is for certain, although some like Switzerland leaving despite the fact of trying to negotiate and getting that higher rate. Tyler, thank you for your work this morning. That is Bloomberg Washington correspondent Tyler Kendall. Now, on trade and how tariffs are being used on countries importing, sanctioning Russian oil, That's been a real focus, especially when it comes to India, getting an additional 25% tariff, now for a total of 50% tariff because of their use of Russian oil in purchases. Joining us now is Bloomberg oil strategist Julian Lee. Julian, I wonder what you make of the targeting of India overbuying Russian oil, despite the fact that other countries, namely China, do the same.
Yeah, I think perhaps there's a feeling that India is more likely to cut back on its Russian purchases than China. I think if you look at what was done in the past with Iranian oil exports, there were secondary sanctions on buyers of Iranian oil. India was one of those that was targeted then back in 2012 and 2019. And it did respond. It did cut back its purchases of Russian oil. So I think that's a big part of it. I think there are clearly much bigger issues around the trade relationship with China. But I think there are some things we have to bear in mind. There's a 21-day sort of grace period before these additional tariffs come into effect. And I think there is a lot of skepticism in the oil market about whether this will ever actually happen, particularly if we do get this meeting between President Trump and President Putin.
To that point, Julian, with an oil market that's been very resilient, if you were to price some of that in, how would that look? And what form does it take for India to look elsewhere beyond Russian oil if they were to try to replace it?
Well, I think from an Indian perspective, I think they would quite clearly look to the Middle East, Saudi Arabia, Iraq in particular. They were significant buyers. They still are significant buyers of oil from those countries. That would add to the competition for barrels from the Middle East. And I think there are sort of two big questions. One is, if India's not buying the Russian oil, where does it go? The only other significant buyer other than China is Turkey. I don't see Turkey taking much more Russian oil, and even if it did, the volumes wouldn't offset what India might drop. So that means, does it all go to China or does it stay in the ground? If it stays in the ground, then suddenly we're taking anywhere up to sort of 1.5 million barrels a day of Russian crude out of the market. The OPEC Plus producers have been very clear that they won't step in to pump more. Russia is a key member of the OPEC Plus group. It has quite close political ties now with Saudi Arabia. So I don't think we can expect more oil from them. That's going to cut the supply of oil. Now, that may not be a bad thing going into the autumn and the winter. Most forecasts are looking at an oversupply. And I think all these things are sort of being mulled over by the market, and I think that's a real strong reason why we've seen a relatively muted impact on oil prices from this announcement yesterday.
Yeah, oil prices, if anything, a little bit higher by about 0.5% for WTI and Brent today. Julian, thank you so much. That is Bloomberg oil strategist Julian Lee. Coming up, earnings, central bank rate decisions, some new jobs data. We're going to set you up for your trading day with your trading diary. That's coming up next. Stay with us on your brief. Let's get you set up for your trading day on this Thursday. We're going to get some more earnings before the bell. That includes Eli Lilly, Hyatt, and Warner Brothers, among others. And we also have a Bank of England rate decision. That comes at 7 a.m. Eastern time, followed by Governor Bailey's news conference at 7:30. Plus, U.S. jobless claims data coming in at 8:30 a.m. And more Fed speak, this time from Atlanta Fed President Raphael Bostic at 10 a.m. A quick look at some of the movers pre-market. Apple pushing higher alongside chip makers, gained 5%, another 3.25% yesterday, with those chip makers that invest in the U.S. getting an exemption from 100% tariffs. DoorDash up 8.8%. Earnings gains extending those that had a rosy outlook. Delivery orders hit a record. And finally, the security software maker Fortinet plunging down 20.5%. Gave a mixed outlook. At least 3 analysts have downgraded their ratings on a disappointing product refresh cycle. All right, that is it for your brief. Surveillance takes things from here. You're watching Bloomberg.